Welcome to Stocks in Translation, broadcasting from the New York Stock Exchange. I'm Jared Blickery, your host. Senior reporter Alexandra Canal is in for the People's Voice, Sydney Freed, who's on assignment. Before we begin, please like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, Amazon, or YouTube. Today, we are welcoming back Todd Sohn, ETF strategist at Strategas Asset Management. Hello, guys. Todd has shared his insight with us twice before, and today we're going to share his love of exchange-traded funds, or ETFs. We've had an absolute explosion of ETF filings with Trump and a new SEC chair taking office. So our word of the day, phrase of the day, is levered ETF. If you like Trump coin or Melania coin, then you're just going to love their 2x ETF equivalent. And no joke, these products have been filed. We discuss. This episode is brought to you by the number $44 billion. That is how much more money has been shoveled into tech ETFs over healthcare funds in the last year and a quarter. Is 2025 finally the year for healthcare stocks to lead the way? And we're going to talk about European equities as well. So before we really dig in here, Todd, got to ask you what you're thinking of the market action this year, because a lot has happened.
Yes. I think the main takeaway is that the trend of the market is still up, but things are evolving. As we saw earlier this week, Nvidia had a pretty big decline. Semiconductor stocks are under pressure. So trends are still there, but leadership is transitioning from, say, tech-dominant market to other corners such as financials or maybe even European equities, perhaps healthcare. Now, the question being, if the broader indices go on to make a new high, is participation still there? That's going to be the most important question heading into the rest of the first quarter and into the summer months. Because that's where durability is made or divergences are made too.
Yeah, that's really interesting. We're going to circle back to that because we have seen a breadth explosion over the last week or two since the inauguration. But I want to get to our phrase of the day here, which is levered ETF. A levered ETF, levered exchange traded fund, uses derivatives or debt to amplify returns, aiming to deliver 2x or 3 times the daily performance of an index, and that's daily performance. They can magnify gains, but also increase losses, making them riskier than traditional ETFs. And we'll get into some of the nitty-gritty here, but a couple of examples there. I brought up Trump coin, Melania coin. We're already, these are new entities, a few weeks old, and we're already getting ETFs. I've seen nothing like this before.
ETF issuers are throwing everything at the wall right now because we're in a pro-crypto administration, pro-crypto SEC, so maybe they'll be more lenient with the type of products they let through. Now, they're only filed. These are not official. They still have to go through the approval process.
Sure.
So I'm a little skeptical of some of the Melania and Trump coin stuff. There's no market for that. But they will be much more lenient in terms of other types of levered products that'll come through as well. You're going to see all sorts of different stocks, right?
And Trump Media just announced that they are going to be expanding into financial services. They mentioned cryptocurrency, so perhaps a place for the Trump and Melania coins. But speaking of levered ETFs, Nvidia, obviously, you were just alluding to huge declines due to that DeepSeek sell-off. And we saw massive declines in levered ETFs for Nvidia, so single stock ETFs. So can you explain a bit of the dangers of that?
Right. So this is my analogy is a food label. If you are at the grocery store and you're going to buy a cookie or something, you want to know what's in it, right? You look at the label and say, okay, there's
Ingredients, sure.
sugar or whatever.
Sugar, a bunch of stuff I can't pronounce.
Yeah. It's the same thing with levered ETFs. You have to understand how they are made. And so they are supposed to magnify the daily return of their underlying asset. And then they have to reset every day. So there's a decay involved with resetting that leverage. So in the long run, they're not really great instruments. And so if you're buying 2x levered Nvidia, which was great in the past year and a half or 2 years, right? And then you get a blow up like this. If it goes down 17%, the product's gonna be down 34%.
And 51% for 3x.
And 3x, there are products that exist like that. The SEC has put more of a ban on them now. Older products have been grandfathered in.
Okay.
So you won't see 3x single stock funds unless something changes in the regulatory backdrop. But there still are 3x semiconductor ETFs that went down in massive amounts. And so this is where risk actually comes into play. You really need to understand what you're doing when you mess around with leverage.
Who's purchasing these ETFs? Is it day traders? Is it institutions? I mean, it sounds very risky.
It's very popular with retail.
Okay.
Because you can make a lot of money in a very short amount of time.
You also lose a lot of
money. Sounds like zero-dated options.
Exactly. It's very similar to zero DTE, that you can make a quick buck, or, as in the case Monday, you can now finally start to lose a lot of money too. So if you're going to buy them, understand what your risk is. How much are you putting into that, right? Because if you add $1,000, you're getting $2,000 of notional leverage there. And have a plan. What is your hedge, right? Just in case something goes south for you.
So I keep emphasizing the word daily, as in they're targeting daily performance here. And I do that because I've seen it possible for these ETFs. Let's say, take a very volatile stock like Tesla. Tesla could go up from day A to day B. And meanwhile, the levered ETF tracking it might go down if the daily volatility in the underlying, which is Tesla, is high enough. So you can have the underlying Tesla making money, but the 2x, 3x losing money. Yeah. And a lot of investors, you got to understand that.
It's not straightforward. It's very complicated. And there's a lot of kind of odd math involved, especially when you have to reset the product every day. Now, there are new ETFs that reset weekly, monthly, and quarterly. Those are still nascent. There's not a ton of assets under management in them, but they're trying to adjust for that daily issue. Problem is, you need to buy it on the day and date to get the full leverage amount for a month, right? You got to buy it on the first of the month and sell it on the 30th of the month. That's kind of a little bit more.
It's kind of hamstringing.
Yeah, there's more homework to do, and you have to remember. You got to set a calendar reminder. And so with daily, you have to have a super high conviction that a move is going to happen. We don't know. It's hard enough to predict markets a day or a week out, let alone a couple of hours.
Mm-hmm. So it's levered ETFs. What about inverse ETFs?
Same thing.
Same type of concept.
And you almost have the deck stacked against you with inverse because over time, markets trend higher, right? Mm-hmm. Over a 12-month period, the stock market is up about 75% of the time. So if you're betting an inverse fund, which is saying markets will go down, a stock or a segment will go down, you already have probability stacked against you. Now, maybe there comes a time where if you were aware of DeepSeek and you said something's going to happen to Nvidia here, that's when you would have
the news did come out prior to the sell-off.
If you were really into it,
right,
and you would have used the inverse tool, but it's another very, very risky, right? You're still levering up. You're still getting 2x exposure on the short side, which is already difficult to do. You have fund managers who are professionals at shorting stocks who are retiring because the market's been so hard.
Do you think we're in a riskier environment today compared to years past? It just feels like it's very speculative.
I don't know if it's riskier, but access to risk is way more convenient. So,
and sometimes that almost is a self-fulfilling thing. I mean, you get that, and then you get some stimulus checks. I'm not saying those are coming. Don't write letters, but that's a formula for bubbles, isn't it?
Yeah. Oh, and I think we've to an extent seen some of that. I mean, the leverage space is booming. There are issuers who are making their living off of it because they can charge a higher fee for that, given all the I'd say the hurdles involved with producing the product, getting a swap agreement and whatnot. So they can charge 1% versus 1 basis point for the S&P 500. But it's all about the access to risk. I can go, if I'm 21 years old, I can go gamble, I can go drink alcohol. It's kind of the similar thing to it now. If I have a brokerage account, I can go lever up and buy 2x Nvidia, 2x whatever I want now. It was not like that 30 years ago, right? You had to be a high net worth individual or institutional investor to access these types of products.
24-hour trading on Robinhood now. It's crazy. Yeah, we do have a lot of access.
I want to get back to inverse ETFs. A question from a loyal viewer who is sitting a few feet from us, our producer, John. No, he channels the audience questions. Let's break down what an inverse ETF is and then also kind of fold in there, what about VIX ETFs? Because you were talking about, the market tends to go up over time, but what about a market like the VIX, which is mean reverting? So
now, here's the tricky part about the VIX funds. They are based on futures, so they're not going to track spot VIX specifically.
And you can't trade spot VIX at all.
Yeah, you can't trade it. So these are buying points along the VIX curve, which means if the VIX goes up 20%, depending on where you are on the curve, it may not happen. There's more complication involved, more reading of the label. So I'm not a huge fan of the VIX products. If you are sophisticated and you want to use it as a hedge against stocks, sure, that can make sense.
But the inverse is just the opposite of a regular ETF. You're betting that something's going to go down.
Right. So the inverse ETF, so they say 2x short S&P 500. All they're going to do is if the S&P goes down 1%, they will give you a 2% return.
And you can do it unlevered too. They're just unlevered.
Yeah, there's 1-to-1, 2-to-1, 3-to-1. But again, they're tricky because markets trend up over time. So you're just betting against something rising, and you have to reset it every day. They're just like levered long products. They're just doing the exact opposite. So if you are bearish on stocks, this is a way for you to express that view too.
And speaking of risk, we've been hearing a lot about cryptocurrency, obviously the crypto ETFs, Bitcoin, Ethereum.
Yep.
If we see prices of Bitcoin perhaps fall or become a little bit more volatile, how do you think that's going to trickle through into some of those ETFs that have come to market?
Gosh, it depends how much,
Yeah.
right? If we go through another 80% drawdown for crypto, I have
Which
to
has
imagine,
happened, what, 3 times?
It's just naturally part of that cycle now. I have to imagine that will tame some of the enthusiasm for crypto products. Usually you start to pull back and say, all right, let's wait for a calmer cycle. Now, though, because there is a deeper options market for crypto ETFs, there are strategies that are coming out that will buffer against declines for crypto. So I can say, I want to be protected against 80% drawdowns in my spot Bitcoin ETF, and my upside will be capped at about 50%. That's the trade-off now. So ETFs are again allowing more access to different types of risk management strategies, which I think is really interesting rather than just buying crypto blindly and holding on, holding on.
You have the bullish sentiment too, right? With
Yeah.
Trump now in office.
Yeah, so what we're seeing from issuers is let's just see what kind of products we can jam through rather than Bitcoin and Ethereum, and I don't understand the difference between any of them. We're going to go Trump coin, Melania coin, which
The difference is something's going to stick on that wall and then we'll trade it.
Yeah,
Yeah,
and
basically.
what happens is if there's one successful product, a bunch of others will also copycat it.
Is that a problem though if these issuers are jamming things through, as you said, or is that a good thing ultimately for the investor because now you have more options?
I think it's great that you have more options, but buyer beware, understand the asset.
All right, let's pause right here. We got a quick break, and after the jump, we're going to talk tech dominance and concentration and a martial arts inspired Who Wore It Better showdown on the runway. This episode is brought to you by the number $44 billion. That's how much more money tech ETFs have absorbed than healthcare ETFs have since the October 23 market bottom. So we're talking about a year and a quarter there. And I'll add, Todd, that tech is up over 40%, while healthcare is up only 15% in that time. And bigger picture, if you look at the healthcare relative to the S&P 500 going back a couple decades to the beginning of the century, the relative strength chart looks really bad recently.
Oh, it's been a rough go for healthcare.
But is it time?
I think there is a good setup of data to start adding healthcare to your portfolio. And it could be broad healthcare, so you're going to get providers, you're going to get equipment and biotech. And that's based off of healthcare's performance over the last 5 years is in the bottom decile relative to the S&P. It just means it's horrendous, right? Okay. Not a great place to invest, but usually when you get extremes like that, that's interesting. And there's been massive amounts of outflows from healthcare ETFs, so that tells me investors have left the space. They've deserted it. And so from a sentiment and a contrarian perspective, I like that idea, especially if tech starts to falter here a little bit more too. There's a trade-off because healthcare does have those growth and value characteristics that you'll get from technology as well.
And you're not the only one that's been bullish on healthcare. I feel like that's
and Eli Lilly was almost
Right.
a Mag 7 competitor back, what was that, a year ago, 2 years ago?
Lilly was almost suppressing a lot of what was going on within healthcare because you take a GLP-1 drug and you lose weight.
And Novo
You're not
too.
getting, Novo Nordisk as well, you're not going to get an operation that would require a healthcare equipment company. So those names were just totally beaten down. And now I think the sentiment towards the GLP-1 stuff has cooled off and you're starting to see some of these equipment ETFs really revive themselves. So there's an opportunity there to us.
Yeah, so you basically are describing healthcare as potential hedge if investors start to take their foot off the gas with tech.
Exactly.
And do you think what we saw with the DeepSeek sell-off is an indication of perhaps more trouble to come with tech? You think that was a one-off event? How are you viewing that?
And you were looking for another maybe event to faltering in tech.
Perhaps. So
Was it a necessary correction too? I mean, these stocks are very overvalued.
Todd, were you hoping for DeepSeek?
I planted it. Flows to tech ETFs have been massive, all in on tech, right? Rightfully so. That's been the right call.
They were massive last Monday on DeepSeek.
Yeah. There's
Buying opportunity.
There's still a buy the dip mentality for tech, which is it's okay. But I do think it's notable that Nvidia cracked here, and you're starting to see some of the other semiconductors really deteriorate. Software's still okay, and I think maybe that's the move now. Go to software within
next trend,
technology, right, instead of semiconductors. But if you were to get software to take a hit, that leaves the broader tech in trouble, and so that's where healthcare comes into play because it's still a large weight. or say something like industrials and discretionary, like those will still at least hold up the benchmarks.
You know, Todd, we can talk about Europe as well.
Yeah.
And it's funny because on our last show, we were talking with Nick Colas of Data Trek, and he likes healthcare. He sees some signs of life there, but he's still bearish on Europe as a potential alternative to the U.S.
The one reason why I think you do Europe is because diversification. And diversification hasn't mattered for so long. All you need is large cap U.S. stocks. But because of the concentration risk, where you have 10 stocks that are almost 40% of the index, I at least want to look elsewhere. And it's been forever since Europe has actually worked. I think it's interesting that the composition of European indices is starting to change. So it was very financials and consumer staples heavy for a long time, right? So yield and defensives. But European industrials have performed very well, whatever the catalyst, whether it's power generation or the war overseas and whatnot. But now there's significant weight in Europe. So Europe is becoming this more cyclical index. That's exactly what you want when you're going to buy something besides the US. So I like it for diversification, that there's not much tech and that there's a lot more presence of industrials within Europe. And you can also make it as a growth hedge to some extent in case the US does go through some more speed bumps.
And speaking of diversification, Jared brought this up with Nicholas with the value versus growth trade. Because, during that sell-off that we saw, we did see value start to outperform growth. Is that a trend that you think could be sustained?
Oh gosh, we could have had this conversation many times over the last decade.
Well, at least 100.
It matters on days like that. Do I want to fade large cap growth? Not necessarily, but I think it makes sense to dilute your exposure to some extent. And so maybe you up the European allocation in your portfolio. If it's 5%, make it 10%.
And that's your value.
That's my value play.
Okay.
Exactly. I don't want to go full blown value because we know what the trend is, right? It's just as you mentioned. But I at least, just in case, to diversify my risk, have a little bit more of it, I think, in this type of environment.
What about sticking with international China? Totally different animal than Europe, but there are signs of life in China. They've been kind of hanging their hat on this massive stimulus program, which has been rolled out in fits and starts, and everybody's waiting for the next one. But we've had some guests in here who like the prospect of a China surprise this year. Is that something that you're at least allowing the possibility for?
I think China's interesting because the sentiment's so bad. Nobody wants it. It's uninvestable, which I can agree to.
How worse can it get?
How worse can it get? And when you look at ETF closures, a lot of them over the last year have been around China. Issuers are saying, these products aren't working, let's close our China products.
That's a great sentiment indicator. I hadn't thought about that.
And the abundance of EM ex-China products now. So every asset manager is saying, okay, we had our EM product, let's do an EM ex-China product because it was influencing the benchmark too much. So the sentiment's really bad. I'm just mindful that over the last 30 or so years, the annualized return for China is about 0%. So China to me is a trading vehicle. It's not an investment. So you have to be good enough to time the entry and the exit.
Yeah, especially with those tariffs that could potentially come.
Yeah. Oh, yeah. You never know.
Yeah.
All right, we got to get to today's Who Wore It Better, because we have an ultimate financial runway showdown on deck today, martial arts edition, as Todd here has the fighting arts in his blood, and we'll get to that in a second. On one side, we have the Federal Reserve, the disciplined, well-trained professional, stepping onto the stage, data in hand, carefully crafting every move and insisting it's in control of the economy's trajectory. It's deliberate, it's measured, it's the authority in the room. And on the other side, we've got the bond vigilantes, the street fighters of the market. No rule book, no patience, just raw reaction. They don't want to wait for the Fed to set the tone. They move first, pushing yields higher, repricing risk, and in some cases, forcing the Fed to change course. So Todd, who's really running this show? The Fed claims it's data dependent, but it's Chair Powell setting policy, or is he just walking around on the runway with something the bond vigilantes threw on him?
I defer to the market.
Yeah.
Bond market. What do rates do? We've been at 450 for a little bit, hanging around this area. If rates go to the upside, does it start to impact risk appetite? Consumer discretionary stocks, industrial stocks. And then conversely, to the downside, is it a plummet or a more controlled move back down to, say, 4% or so? So I always defer to the market as opposed to what a person says. That's why I like the sentiment data so much, where I can see fund flows. I can see what people are doing as opposed to what they're saying in a survey or a press conference.
Nice. How do you measure these fund flows? I get weekly reports, but is that something that you just are able to calculate yourself on a daily basis?
We have our data providers, and I'll use some Excel wizardry to accumulate meaningful in different sectors and whatnot. Because in the big picture, ETFs are always taking in money, especially your standard type of blended funds, large cap blend, S&P 500 stuff. But when I see certain corners express a lot of fund flow enthusiasm or cash-like bond ETFs, that's when there's an interesting message there, or at least some clues of what sentiment is.
All right, we hinted at your martial arts heritage. I'm going to call it heritage, something that you did not necessarily take up the mantle yourself, but tell us about your family.
Correct. My father is a martial arts instructor for
I love that.
35 years.
I'm assuming 9th degree black belt, all that good
He's
stuff.
got too many black belts. I did not take up the mantle, but it has definitely instilled a lot of discipline in me over the years.
And you're trading.
Which helps in the markets, right? In terms of psychological game there too. So he's always asking what I think about the markets. I just tell him to stay invested.
Well, I wanted to ask you about that too, because we talk a lot about market breadth, right? And you pointed out that 66% of stocks are above their 200-day moving average. And if that shrinks, not good.
Right.
What is the risk of that thinning out potentially?
So far, we're okay. Right. And you think of it as the starters and the bench. The starters are the Mag 7, the top 10 weights. Those can keep climbing higher. But if my bench does not support the index, that creates a problem and everyone gets exhausted and the index will collapse, right? So I don't want to see that move south of, say, 60% throughout this year, especially if the market goes on to make a new high. If we decline, that number will ultimately decline too, and then we look for an oversold condition and whatnot. That's a whole other path. But you never want to see, and that the example is the tech bubble, when a market cap index rises without the support of market breadth. So it's okay for now. Financials, industrials, they're supporting that. Discretionary, that's okay.
So you don't think we're too concentrated at this point?
I think the surface level concentration is a problem, but at least there's still a lot of stocks. Under the hood. Under the hood, there's still stocks rising, but if you are a passive investment holder, not to scare people, you just want to be mindful that you have a lot of dollar allocations into a short list of stocks.
Any thresholds you watch or you're concerned about here with respect to these allocations?
In terms of the top 10, that's it. So if you think about it, if you own the S&P 500 and you own large cap growth, and maybe you own a couple of AI funds because that's your fund money, you own a lot of Nvidia, Microsoft, and Apple, and Amazon to an extent. So just be aware of, when you are buying large cap ETFs, how many of the same names are at the top of that ETF. I think that's the most important thing for investors to realize, and why Europe or healthcare matters for that diversification, because a lot of them are tracking the same type of stocks. They're all tangled together.
You are a CMT. In fact, I believe we met at a Chartered Market Technicians event here, and that's where all the technical analysis people get together and exchange stories, and they're scintillating. At this point, the people's voice would usually kind of roll her eyes, but I swear we have.
I love our technicals. Are you kidding me?
Thank you. We actually have no more time, so we are going to officially wind things down here at Stocks in Translation. As always, please make sure to check out our other episodes on the Yahoo Finance site and mobile app. We are also on all your favorite podcast platforms, so be sure to leave a comment and subscribe wherever you get your podcast. We'll see you next time on Stocks in Translation.